I can set my minimum a lot lower than if I am raising 5 million to go after a bigger property. What that means for me is that I can get a lot more people started in the investing, one of my goals and missions, because the check size can be found near, 25, 20, 15,000. I can get a lot more people in because that's a lot more attainable than a minimum check size of a 75, 100,000. So that's another way to accomplish the goals that we're trying to do here.
Welcome into the Get Invested podcast, a podcast about all things real estate and real estate investing, brought to you by Capital Velocity Investments and a part of the Matthias Talks Investing Substack.
Hello, everybody. What's up? Welcome back to another episode of the Get Invested podcast with your host, Matthias and Jordan. We're excited to be with you today and talk all things real estate investing, and probably some nonsense. Now, Matthias, I don't know if you noticed, I did put this in the last episode that was released, which will be, when we're recording this one, it'll be a couple weeks ago.
Yes.
I just want to bring it up here because it was so funny. The AI translator to moving it to the transcript, when I said chicanery and tomfoolery, spelled it like Shaq, S-H-A-Q, and then A-N-E-R-Y, like the particular version of chicanery that Shaq gets up to.
Nice.
And then tomfoolery was a person's name. It was Tom, capital T,
Foolery.
and F.
Yeah.
So like, yeah.
It's an
foolery,
Irishman.
yeah. But that one is like something, okay, people made that joke before, but to see like chicanery with them just saying, oh yeah, obviously he means this made up word with Shaq. It just reminded me of inside the NBA. I don't know how long they did it, but there was a while there that every once in a while they'd have like basically bloopers and things that happen on the NBA court that are ridiculous. And the segment was called Shacked and a Fool.
Oh, nice.
So anywho, maybe I'll hit him up on Twitter and let's see if I can get a response.
Sure.
Anywho, I had to start with that. Well, let's transition here into our topic today, which is something we wanted to expand on, something that Matthias wrote a newsletter about that would have come out a couple weeks ago. We thought it would be a good platform to talk about a number of different aspects of the business and kind of where we're moving at this point. So we're going to talk, I want to say, more strategy rather than the nuts and bolts of the last couple. Yeah. All right, Matthias, you take it away for us.
Yeah, so I'm going to kind of frame this in more Warren Buffett talk, basically. But one of the big things that he liked to talk about when he got into buying businesses, he cared about a few things, but two of the biggest items were good operations, and strong track record of operations, and a wide moat.
Okay. All right.
Yeah. So and we're going to talk mainly about the wide moat thing here today. So basically, businesses with a wide moat are businesses that have a strategic advantage in some way or another that keeps competition at bay. That, like, because naturally, if you're earning high returns anywhere, doing anything in business, competitors are going to try to jump in and share, right? But the wider the moat that you can build, and we'll discuss some of the ways we do it in real estate, but like the wider moat you can build, the harder it is for competition to come in, and therefore the longer your returns stay high, above average high, basically. So moats protect returns in any business, and in the real estate business, it's especially important. But basically, what we do and this has to do with the markets that we operate in. That's kind of mainly what we're going to talk about today, and how we establish a moat, or what moat. Establishing that wide moat is why we stick to some of these markets that we're in. Basically, we stick to secondary, tertiary markets. We don't want to play in downtown big cities. We don't want to deal with that because of the competition. Is one of the biggest reasons. Institutional money, huge hedge funds, billionaires, millionaires, all these big REITs, all these big players deal in the major cities because they are their lowest risk in terms of lack of demand, right? So rental demand, people want to live in apartments everywhere, but mostly in concentrations of humanity known as big cities, right? So there's always going to be demand in the big cities. That's where they like to play because they have so much. They write these big checks, and they just want to hedge against the risk of loss of demand in those markets. So I'll explain a little bit more about that, but I'll let you jump in before I yammer too much.
Okay, well, it being me, I'm thinking through all the different nuances and implications of the analogy of a moat, and which ones we can extend as like actually a part of the explanation, and which like kind of fail, because all analogies eventually, of course, fail because they're comparisons. But first of all, I wonder if I don't think there is such thing as a skinny moat, but I guess there can be an extra wide moat, because if it's skinny, you can just jump over it, then it's not a moat. Yeah. I was just thinking about the idea of bridge, but I'm going to move past that. But I was trying to come up with since you said it's so much for us, the moat is partially the markets, right?
Mm-hmm.
I'm trying to think of an acrostic, like acronym, essentially, like what all of the letters stand for. T's tertiary. That's as far as I've gotten. But I think it's interesting. One of the things I'm going to be interested to talk about, and I'm going to throw it back to you of this, is the different ways that one can produce a moat, right? Analogies, they're beautiful because they make concrete, abstract concepts, right? That's their point. That's their whole reason they exist, or to teach a logic in something more accessible. So I'd be interested for us to talk through the ways in which a moat can be produced when it could be like in our situation, literally it's space in some way, right? Like it is actual space. But in a lot of other ways, I'm sure there's other ways to have that separation, if you will.
Sure.
From a company. Yeah.
Yeah. So what we mean by it and how we're doing this is like I talked about, all the big money wants to go. Everybody wants to play in the hot markets. Everybody's heard of that. Rental demand is huge. Everybody's moving to, they just new Amazon campus, new Tesla, whatever. Tech companies moving in AI data centers, something like that. That's where everybody's going to try to go. Right. So, which is, as they should, there's going to be a lot of demand there. However, it's the more demand there is and the more recognition there is, the harder it is to build that moat. So what we like to do is we like to go to the places that have the strong fundamentals that nobody's heard of. If that makes sense. If that's that's the moat we're building. We have the strong fundamentals that still have growth. It's not going to be as astronomical and it's not going to be as flashy. It's not going to be the sexy markets, but it's going to be, hey, there's strong growth, steady growth, but it's a smaller market. So that's the moat that we're building, is we're going, hey, I want to find some of these same fundamentals of the Miami, the Orlandos, some of the same fundamentals, but I want them in a smaller scale, and I want them in a place nobody's talking about. That's why we're so strong in the Southern Mississippi market, is because we've gone to investors or other syndicators and potential partners and gone, hey, we've got a great deal in Southern Mississippi, and they go, Mississippi? And that's good for us. It's bad for us when we're trying to raise funds and people don't understand, but it's good for us because that means they're not looking to buy properties in Southern Mississippi, and the vast majority of people are not. Same with rural Indiana, other places that we've talked about looking in. That's why we're looking in those markets, because that's the moat. I haven't heard of it. I don't know anything about it. That's a moat. Nobody's doing research on random markets. Very few people. I won't say nobody. A lot fewer people are, and that's the moat we're talking about. That it's going to be hard for them to overcome to come be our competition. And like I said, the risk for big money goes up in smaller markets. Not necessarily for us, because it's this. We're not doing $100 million deals. They are, so they're going to do those in the big markets. The deal size is going to be smaller. And that keeps out a lot of the big money, especially with the added risk of a small market for their big funds, if that makes sense. So that's exactly what I'm talking about when we talk about building the moat. It's a supply and demand, simple supply and demand. There's less investors looking at these smaller markets, even though the fundamentals are equal to or very similar to some of these other big markets that are really hot and everybody's talking about. Fewer investors means fewer bidding wars, lower prices of acquisition for assets, and it's just you don't want to be fighting to acquire. You'd rather be fighting to sell, obviously. But the control. So in my newsletter, I'm gonna branch out here for just a second. In my newsletter, I wrote about this. I mentioned, hey, if there's nobody's looking when you're buying, nobody's gonna be looking when you're selling. True. the same principle does apply. So it is tougher to sell in the smaller markets as it is, or than it would be in like an Atlanta or wherever. But the difference is you have control over when you sell. You know what I mean? So you only sell when you get the offer you want. And, the way we operate, we have long-term fixed rate debt, stabilized properties. We don't ever have to sell until it makes sense for us to do. Obviously, we want to sell it on our timelines to make our returns and all that stuff. But the good news is we're never going to have to take a hit from being in a small market because we get to control the timing on the exit. That's the big defense that I wanted to talk about. But I'll pause for you. I've been talking a lot.
Well, you talked about, I think, 2 distinct things there. It might have been 7, but I think 2.
You never know. I rambled.
The knowledge advantage is a
Mhm.
moat, right?
Mhm.
And that's 2 different kinds. It's knowledge of like areas and then knowledge of execution, right? So there's that, and that's a niche essentially, right? That's one of the things that is you have a service, if as it were, that others don't provide, or not many, and there's room
Harder to do.
there's
more
either
effort.
room for all the few that are there, or it's a matter of you can do it better than they do, whichever it may be. So there's the knowledge advantage, institutional advantage in that regard, and then you talked about the other part of that, and I guess this comes back to the execution, is that we talk a lot about people who I don't want to say a lot, but we have brought up a number of times that in conservative underwriting, the counter example to that is people who make an investment or make a deal happen betting that when the time comes, when they need it, right, the loan market will be there for what they need. The refi will be there for what they
Rent
need.
growth is going to continue at the same trajectory.
Rent growth is
it has.
going to continue at a high rate. The asset will appreciate. The cap rate will, come down. Then there will be a buyer of some sort, whether that be a bank to give them more to help them with the loan, or someone purchase. Like that absolutely will happen, or has to happen for it to work out. So the moat for us, as you said, is that we're buying places that we know can produce steady income. We're not overpromising on the returns, and we don't have a gotta bail out, grab your parachute, right? Like timeline where it's like it has to work at this moment for it to make sense and or not get underwater. So those are 2. Not that I'm not gonna say like we're doing it this way and everyone else is doing it the other way, but that is just as a contrast, the expectations of steady income versus escalating.
I would also argue, that's part of the moat is that we're able to consistently buy operating in the markets we operate in. Let's say investment firm XYZ versus us. I'm just going to make up some numbers here because we're in public. 10%. Let's say we're making 10% returns and they're making 10% returns. My 10% returns are more protected because I'm able to consistently buy at a lower. Our returns in a smaller market are going to be more protected because we're going to be able to consistently buy at a lower price, a lower, not having to fight as much competition versus in a big market. XYZ firm is going to have to outbid everybody else that's bidding on the same properties that they're trying to buy. So I'm much more likely to consistently buy at a low basis that'll protect my returns than they are over time, over multiple deals. So that's a moat right there versus other investment companies. That's one of the I like to protect against like anybody who buys in those cities has to do bidding wars. They have to win bidding wars because there's enough people looking. So I don't participate in bidding wars. I try to avoid them at all costs. I've been in some and I've won some, and I've actually won some. We'll talk more about this later, but I've won some with lower bids than other people had. And that's a big topic we'll talk about in a minute. But that's another piece. That's another dredging of that moat is the ability to buy at a good basis without fierce competition to just get a property.
Yeah. So first of all, just for anybody out there who isn't tracking, low basis is essentially low cost for what you're getting. It's bang for your buck.
For higher cap rate, meaning you're getting more income for less real estate.
Each dollar you're spending is
Less
getting
dollar,
more income.
less. Yeah, exactly.
So just first wanted to make sure we were all on the same page on that. But I think the interesting thing is to clarify here that I think if people hear this idea that like you're going into a market with less competition, they're like, wait a second, you are providing a service, right? Like you need, it seems like you would want there to be multiple people at any given moment wanting your apartment or wanting your townhome or wanting to rent.
Well, they want to rent. I
But-
want them to want to rent it. I don't want them to want to buy it.
So that's
While
where
I'm
I'm
trying to
heading with
buy
this
it.
is that we're talking competition to buy.
Mm-hmm.
And then obviously at some point, if there's too much demand of a product, it's going to hurt any company. But in this instance, yeah, what we're talking about is the competition to buy a property.
Other apartment buyers. Thank you. That's
exactly,
good clarification. I don't want to confuse
yeah.
people.
So because of course, if there's a lot of people who want the property, we have a better chance of not buying. If there's a lot of people who want to stay at the property, right, then we have a better chance of maintaining our
that's
rent rate. So just a clarification there on that. But why I think, I mean, they go together so well is that we're able to get the property that is going to make money and that we know we can improve the income on for a low basis because no one else is there, which also explains kind of the flip side that you've already brought up, which is when we sell, if we don't have a timeline, it's just a matter of, okay, there's someone else for whatever reason, whether the situation in that area has changed and it has attracted investors, or there's all of a sudden someone else who's looking in the area looking to get in. And at that point you can sell. So it's the very reason that we're there means that there's a very good possibility that someone else will come along to try to do the same thing when it is time for us to sell or want to sell. Does that make sense?
Yes, the key point there is like there's always people doing, I'm not the first person to think of this. There's plenty of people that only deal in small markets. But the when you own it, you have the and you're stabilized and cash flowing and not over leveraged, which is the way we operate. You have the luxury of waiting until that other dude shows up to sell. You don't have to just axe prices and hope somebody comes along or take a loss or whatever to sell because your loan is up or whatever it is, and you're over leveraged. Those are the things that would force you into not making your returns because you just had to exit at an inopportune time. But when you're stabilized cash flowing with long-term debt, you can wait as long as you absolutely need to, and you can even keep extending, keep refinancing if you need to, as long as it's a solid. You may not be pulling cash every time, but you're just kind of rehacking the clock and eating that cash flow the whole time. There's nothing wrong with that, and that's a great safety mechanism to have when you're protecting those returns like we're talking about.
Yeah, and I did want to go back to something you said earlier. First, you said rural Indiana, which if you're clarifying that it's the rural part of Indiana, I don't think we're looking in that part of it. No offense to the Indianans out there, but if you're clarifying what part of like that level of rurality for Indiana,
outside Indianapolis.
Yeah. So I don't think we're looking in rural Indiana because we're not looking in rural Mississippi. And that was really where I was going with this is that people hear Mississippi, right? And you said you brought it up earlier, Mississippi, but they're thinking on a statewide basis, which doesn't really make any sense, right? No one buys
Real
apartments on a
local.
statewide basis. Yeah.
Always.
That's not a thing. I mean, if you said, I'm buying in New York, and they're like, oh, okay, that makes sense. And then you clarify that it's like outside of Schenectady, or some place that they've never heard of in central New York that's like far away from everything and is as rural as any place in the South you can imagine. It would exactly. So, if you're buying the population centers of a state, sure, that is a lot of rural, okay, but that there's a concentration of people. That's the whole point.
Yeah,
right?
Exactly.
So that's an interesting, and we got a lot of like, oh wow, Mississippi. That's they think everyone, not they. I don't want to cast wide nets, but the people who responded that way, it was clear that they were thinking on an aggregate level that just doesn't apply.
Yeah, I mean, and that just goes back to the Warren Buffett thing is, if a crowd's running somewhere, you need to be looking the other way, because that crowd, all the crowd's going to do is drive up prices, and you're not going to make the returns, the safe returns. There will be a few people that make returns, but the vast majority are not going to get the same returns. It rewards who got there first, and everybody else is kind of chasing the dragon, as it were. I don't like to look where the Tampa and the and all. I don't like to be the person looking where everybody else is looking. I'd rather stick to my strong fundamental markets where there's, like I said, less competition. But there's another huge point that that I want to bring up in terms of moat that we're for the smaller markets. Barriers to entry, right? That's part of the moat. Is it's harder for competition to show up and capture some of your returns. The barriers to construction in the smaller markets is huge compared to Atlanta, Dallas, everywhere, all the big places we talk about. So we've had some serious interest rate fluctuations over the last few years, right? They shot way up, unprecedented, super fast. Construction just ground to a halt. All the stuff we've talked about this at length, but just rehashing a little bit. Construction completely stopped. They're delivering. It takes 2 to 3 years to bring apartment development to market from step one to people are moving in. 2 to 3 years. That's all happening. It's all finishing up right now as we speak. And behind it, there's a black hole of construction, of no new construction, because the interest rate shot up and the cost of new projects was way too high, and developers are very skittish when the cost of capital is high, because they have such that 2 to 3 year holding period. That's a long time to be paying risky debt. So what that means is there's very little new development going on in the country right now, like on a average, according to the average basis. It's way below the average. Well, when it comes back, as interest rates have been slowly trickling down a little bit, they're fluctuating still. They're not really coming down, but they're not as high as they were at the peak. So some construction is starting, but just what are the things we talked about earlier? Is like the risk is lower to losing demand is lower in those big cities. So whenever they start building again, it's going to those big cities. They're not going to build apartment complexes next to my complexes in Hattiesburg, Mississippi. Because even though the demand is there, the fundamentals are there, there's a lot of risk of developers taking on, and they're going to take that risk first in Charlotte, North Carolina, or Nashville, Tennessee, versus Hattiesburg, Mississippi. And that's what I want, because I don't want one of the worst things that can happen to and I mentioned this in the newsletter. One of the worst things that can happen to an apartment deal is that if they build brand new, really nice apartments, right across the street from you, what are you going to do? You're going to lose occupancy, and it's going to hurt your rental rates, because the market's going to absorb that new. It may eventually come back if the demand fundamentals are still strong, but now you've gone years without meeting the cash flow and the returns that you've expected, because you didn't anticipate another property being right there.
Because even if it is, say it's an A to your B, it's new. They're going to be cutting deals. They're going to be getting people in.
Exactly. Especially for like that first year, like you don't go straight.
They're going to be cutting so many deals. Yeah.
You don't go straight to market rates with the first deal or the first year of property. You just you're going lower. So they'd probably be the exact same rate as you. Like let's say you're a B, a B property across the street from a brand new A property. They're going to be putting people in for B rates that first year, and everybody who looks at your property and goes, why would I move into the old property for the exact same price as the new property? And it's gonna crush your cash flow for as long as it takes for that thing to fill up and start getting their prices up. But even then, there's going to be filtering, and it's still going to take. It's going to take some of your, as a B investor, some of your tenants are going to go, hey, I can actually afford a little bit more, but I liked this location, but now that across the street's available, I'm moving out over there, even though it's a little bit more in rent. So there's a whole bunch of problems that can have. So in the smaller markets, it's harder for the big developers to come in and crush your returns by building than it would be in a bigger market. Same as where all the the competition for buying.
And now this is just pure speculation based on logic, but it would seem to me if they are going to come build, the demand rate is going to be so high, and it's going to be such a sure thing that when they do build, it won't
Mhm.
hurt you as much because they're just kind of like meet what's already there rather than be fighting over a static amount.
Exactly. That's an excellent way to look at it because if I'm just thinking like, what would I do if I'm going to develop in Hattiesburg? I'd have to know that and I'm also not going to build as many units, right? I'm not going to build a 150 unit. I might build an 80 unit in a smaller market to where I might not get the exact same return as I would price per the economies of scale and everything for the 150, but it's a lot more guaranteed in a smaller market if I do a smaller project. And so it's, they're not going to put a 350 unit complex down the street from our property because that would
Right.
be so, even though in my opinion in Hattiesburg they'd fill it, we would feel that impact if somebody did that, but they're not going to do it because that is a risky play.
Right. Right. Uh, yeah, I was just thinking about your examples earlier of the crowd, and they announce some big construction project that's going to bring a lot of jobs and a lot of people.
Mhm.
And it seems like this is another part of that moat, which is that those kinds of things happen in secondary and tertiary markets too. The announcement's just not as loud and it's not as broadcast, right? So if you're paying attention, let's say SMU, not SMU, sorry, Southern Mississippi. I'm sure they don't want to be
Southern
confused
Methodist.
with Southern Methodist in Dallas. So the Screaming Eagles, I believe, is is that it? Southern Miss? Is it the Screaming
Something
Eagles?
Eagles,
I know it's the
Golden
Eagles.
Eagles.
Is it Golden
Golden
Eagles?
I should
Anyway,
know this. Sorry.
Yeah, we should really. But sorry, anybody who's a Southern Miss grad, which I think includes some people that manage property down there for us. So sorry, guys.
We'll work on that.
The Mississippi announces, I don't know, like some new research facility, or the demand in the state has grown to the point that they're going to start letting in 1,000 new freshmen, or stuff like that. Whereas that's going to obviously create demand, but that's just kind of again, as the metaphor of the newsletter, flying under the radar for a lot of people who would kind of bring that.
Yeah,
too
and
much.
That's more that knowledge moat. If I know that
Exactly.
a secondary tertiary market is a business friendly, they're actively courting, industry or whatever is going on. If I'm aware of that, I'm looking to buy in there because I know there's a good chance in the next 3 to 5 years after I buy, hey, they're going to be bringing in a big campus of Toyota or whatever, what have you. Now, guess where everybody's flocking and who owns properties there?
Yeah.
You know what I mean?
Right.
So
absolutely.
I got in before the early birds on that one. So we're sitting pretty in those scenarios.
Right. Absolutely. So on that moat, coming back to our central analogy here, it kind of last part of it, we kind of changed the imagery a little bit.
Sure.
If you think about it. So but I don't know. I didn't want to jump ahead. That seemed like a natural segue into
sure. Yeah.
Our bigger final topic at the end. But okay. So you want to make that transition, and guys, just hold on to your metaphorical hats because we're switching the metaphor here. Go ahead.
Yeah. Okay. So part of what we want to be, and I wrote about this in this same now infamous. We're making an infamous newsletter. I want to be
if only.
I want to be the guy in a small market. I want to be the big fish in the small pond, as it were. And in a way that we've seen to, we're kind of looking at doing that is, by focusing on the smaller ponds per se, the small markets. But so we've talked about lower price, lower basis means people with less money can get in. So that does mean more competition to a certain extent. However, let's say we're going after a 50 unit in a smaller market. Here's what typically happens. I'm gonna back up a little bit here. Typically happens when you do what I do is you buy, just kind of what we've done, right? I bought an 8 unit, bought a 17 unit, bought a 20 unit, bought a 55 unit. You just keep going up until you get to the biggest investors, the biggest properties you can find, because the economies of scale are better and the checks are bigger, right? So that's what people try to do. They try to scale up and go big as fast as they can. What I'm thinking, and kind of my strategy here is I don't know that I want to move on to the 150, 200 unit properties just yet. One, because we're operating in smaller markets where those tend to be a little bit more risky. due to all the stuff we've talked about. But also, and we're not operating in like tiny towns, so 200 units is not that risky. And
And
like
I do feel like people think it's like a one stoplight.
Yeah, we're not talking that small. We're talking small comparatively.
Yeah, exactly. Comparatively to the largest cities. Yeah, yeah.
Right. So my thought is, what if I'm the experienced guy who has a whole bunch of 50, 60 unit complexes? My offers and my reputation in these small markets is going to be, because as other investors are doing what I just talked about, trying to step up, they're going to be coming from their 20 unit to the 50 unit in this scenario that I'm making up. But I'm a guy who owns a couple of 50 unit properties in the area or in similar areas, and I can just point to a track record that shows it. My offers, even, and this is what I was talking about earlier, my offers are going to be stronger than somebody else's anyway. Even if, let's just say that we both offer the same price for the property, mine's going to be a lot stronger because I have the track record to back it up. Whereas their track record in this scenario is, hey, I've only got, a couple of really small apartment complexes. I'm trying to work my way up, and there's nothing wrong with that. That's exactly what I did. But in terms of being able purchasing power and keep that price low, my offer is going to carry a lot more weight in those smaller markets where I have a reputation than somebody who's unknown, or who hasn't done it yet. That I see as another way to build a moat, is that if I can, plus the fact that I have experience operating less than 100 unit properties, in the 50 to 80 range, something like that. If I have a lot of experience doing that, which is a little bit harder to do, a little bit more focused on certain, key performance indicators of efficiencies and things like that, you have to stay on top of it a lot more, because you can't always have an on-site manager, you can't always have on-site full-time handyman. You're going to have to be more efficient with your time, with your decisions, a little bit more deliberate, which we have practice doing. I can operate things at a better expense ratio, at a lower expense ratio than potentially somebody who's just trying to work their way up. And, this is the first 50 unit they've come across. I know exactly what I can pay because I'm experienced at it, in order to still capture my returns. And maybe I can outbid them because I'm more confident in my numbers, knowing what it's going to take. And he can't be that confident because he's like, hey, it's just going to be extra expensive. He doesn't have procedures in place to capture some of those efficiencies. Or maybe I can spread out some of the efficiencies across multiple properties in the same market. If I have two 50 unit properties, I can manage those with the same manager, the same handyman in the same market. That's a huge advantage I have over somebody else who has to front those costs for just one of them. You know what I mean?
Yeah, absolutely. I mean, first of all, there's kind of a basic fundamental concept of, in this instance, actually, I think one way you could say economies of scale, in that if you can cover more with a concentrated amount, of course, than someone who's doing it's a one-off. What I think maybe we might want to be sure we're clear on here, though, is that two things. One, why your track record will matter in a bid. And then the second one is, if we are talking about specializing, essentially, right, in a particular size, why is that a size or a range that there's an opportunity in which to specialize? So they're kind of just explaining both of those like logics there.
What was the first one again? Sorry.
Why your track record
Gotcha.
would help you win a bid at a lower basis, or even the same basis. Now, if you can outbid because you know how you actually know exactly how much money you can make because you're going to have efficiencies. But let's say you bid lower than someone who, say, doesn't, even if they do other things that are impressive, they haven't done this, or they haven't gotten to this point yet. Either way, why would you be able to beat them with a lower bid? Because you have a track record. Just make sure you walk through that.
Yeah. So the track record that a seller of a property, and I've sold properties and before, so I know I've been this person. You don't really want to get on a contract and take your property off the market if you're selling, unless you're pretty confident this guy's actually going to take the deal down. When you get into multifamily or really commercial investing, there's a whole bunch of people who like to come out and kick tires. They could be wealthy people who have to place some money or just want to place some money, not that serious. So it doesn't even have to be a capability of having that kind of money type thing. So if there's let's just say a $3 million property, there's people with $3 million who look around rural places and go, I might buy that. I've owned a property before. I might buy that. Might be a good investment. Typically if you have that kind of money to throw around, you're generally familiar with investing of all kinds. But if that guy doesn't own any other properties and I'm the seller, and then there's another guy who just closed on 2 properties the previous year of similar value or similar location, something like that, then I'm going to go with the guy who seems like he does this regularly, because the other guy could be just kicking tires. And what you don't want to do is you don't want to keep pulling getting under contract and then coming back to market, getting under contract and then coming back to market as people drop your property. So the ability and the apparent willingness to close are 2 big factors in being awarded a contract when somebody's selling. So if they think you're serious, it's a lot easier to do business. And if you look like you know what you're doing, aka have a track record of owning and operating this type of property, they're a lot more confident in going under contract. They may not ask for as much earnest money to protect themselves. You know what I mean? It's just, that's where the track record really matters.
Yeah. I just want to make sure we spelled that out, and I think it's good that you split it into the 2 there, the willingness and the ability. Cause for one, in my mind, I was thinking almost entirely ability. Like, can this guy over here raise this amount of cash 2 to 3 times last year? And in his lifetime, he's done it 8. And then, this person is just getting started, which of course we hope to have a win at some point, just not over us.
Yeah. Yeah. There's plenty to go around. I still just want to have my advantages.
Exactly. So there's that. Oh, okay. Well, I mean, I would assume even if the seller if someone's selling an apartment building, they're probably sophisticated in this understanding, but maybe probably the broker at least will tell them that, like, hey, this is what could happen. They could have all the intention and the willingness in the world, but maybe they just can't get the funds, or like they can't raise the money, or they don't raise it in time, or maybe they didn't plan well enough in this way and that way because they're new to it. So that was what I was thinking, like the ability, but
both matter. Yeah.
Adding the willingness, that they're actually serious about doing it. That's an interesting one. I mean, what a hobby to go get under contract to buy apartments and then be like, nah, never mind.
It happens way more than you think.
So I just want to make sure everyone understood why. I mean, because everyone understands experience obviously is better, but track record equals being able to get a property for less is about the fact that it's actually going to happen, which is, everyone has bought a house and understands that it could fall through, but I feel like the percentage of time that it falls through in a residential house is much lower than it is in commercial.
Yeah, because it has a lot more personal impact than losing a deal. Yeah. Like, it's not your home. You will have a place to live if you don't close on an apartment acquisition. You may not have a place to live if you don't close on your home, and vice versa.
Right. So there was that part, and then the other is, I think it's interesting to say, we could actually, since we want to get it on a low basis, right? That's kind of the premise of the whole market thing, but we can actually outbid someone if we have operational understanding and efficiencies. Exactly. Yeah. So I wanted you to just kind of circle back to why this is a niche that could be filled, and like why this is a kind of target size.
Because it's in between. So it's all those people jumping up. There's some institutional players a lot of times, and the experience indicators, it's almost not worth their time and effort to come down. And there are some fixed costs that are relatively high as it comes to a 50-unit property versus a 500-unit property. There's some fixed costs where, like, for instance, the SEC paperwork and things that, like, that's the same cost for the same all sizes of property. So at some point you're getting down into, and your fixed costs are getting bigger and bigger across your spread of, your efficiencies. So that keeps a lot of the bigger players out. But again, it's high enough that you're, somebody who owns a quadplex isn't necessarily going to jump right to a 50-unit. They may try, but I'm gonna beat out those guys, but I'm also going to avoid the guys coming down, especially since they haven't spent the time to figure out those same operational efficiencies that we're talking about, so where, hey, I can spread my handyman across 2 different properties in the same market. They're going to know that, hey, I can't do that if I just buy this 150 unit, and so that'll keep them out as well. So it's the in betweener, and then
Tweener.
yeah, exactly. So that's kind of the thought process behind, the, I don't know, maybe 40 to 80, 40, and it depends on the market, because some, the price per unit in one market may be higher than another market. So it all depends, but generally in that range, a lot of bigger players don't want to look that low.
Right. So for them, it's not a large enough economy of scale to bother with. And for the other side, it's too much of a jump, most likely. Potentially. And I think, just to be clear, if you have small properties, you're not going to need constant services the same way as you do when you get to a certain size. And so the bigger sizes, like above 80, are big enough for you to have a handyman on site and all of these very important roles filled on site. But if it's 40 or 50, it may not cover that. And then you're just doing it a la carte unless you have a plan.
Exactly. That's way more expensive to operate that way than it is when you have somebody full-time staff. His job every day is just bounce around a unit to unit doing the thing.
So I was just trying to give an example of like what you mean by operational efficiencies. If you have more than one in the area, you can employ a handyman full-time, maybe even 2, depending on how many properties you have, and cover all of the properties with those handyman. Whereas if you only have 1, or if you have 2 small ones, that may not work as well. So at this point, we're getting into processes, right? As part of it, and it goes back to the knowledge gap. So just wanted to make sure that we were clear on that. But we've crossed the 50-minute threshold. That's usually when we are. There's this, you can't see it, but there's like a light over here, just like, starts flashing.
It's like
right
the
in my
comedy club when they like, hey, give me the flash at X amount of time. Sure.
Yeah, exactly. Or, back in my speech and debate days, you'd hold up like how much time they have left, and then they know they got to wrap it up. Anyways, so I'm going to throw it to you for any last thoughts, and then I do have a question.
My final thought is the other non-competitive advantage market moat talk that I want to discuss with this type of strategy, where we're going after these mid niche market or mid niche size properties in a smaller, secondary, tertiary market, is our personal goals, our company goals here at Capital Velocity Investments. When I'm going after 50 units for a total price of, let's call it $3.5 million, I may only have to raise 1.2, 1.3 million. I'm just spitballing here. Who knows? This is not a specific property, people, but I may only have to raise 1.3, in which case I can set my minimum a lot lower than if I am raising 5 million to go after a bigger property. What that means for me is that I can get a lot more people started in the investing, one of my goals and missions, because the check size can be smaller, because I'm still always limited to my 35 that I can take, but I can get more people in if my minimum check size is down near 25, 20, 15,000. I can get a lot more people in, because that's a lot more attainable than a minimum check size of a 75, 100,000. So
right. And that's
another way to accomplish the goals that we're trying to do here. And not just another reason in favor of almost pivoting to trying to specialize in these mid-sized properties.
Yeah. And that was actually something I was going to bring up, and I'm glad you did, that the price point, if you will, aligns, dovetails, integrates, whatever you want to say, with the mission of the goal of the company to bring in new investors or less experienced and people who would have never done this otherwise, to get them started. So that's a really good point to make. So my last question, though, is on my Moat acronym here, I've got maximize knowledge gap, operational efficiency, and tertiary. But I don't have anything for the A yet. What do you got? You got anything for this A?
What was the O again? Operational efficiencies, access limiting.
I was thinking access granting, because I was thinking more about the investors we can get involved. But you're thinking,
I'm thinking it's harder for developers to access these little
Mhm.
markets because it's riskier. But either way, access. We can do
Access. Just put access. Exactly.
There you go.
Especially since one of mine is, maximize knowledge gap. That's a lot. That's a lot of words for what I'm going for here. So, all right. Well, there you go, guys. We completed it. We completed this Moat acronym. So I suppose I'll put this up in the show notes. We'll see. But we really appreciate you guys hanging out and listening to us. If you like what you heard, please restack, like, heart, 5-star, all those things. But better yet, we'd love to hear from you. Send us your thoughts, questions. If this struck something in you that you were like, oh, I never thought about that. I would love to know more. Any of those things, please let us know. Please reach out to us. You can reach out to us on the Substack. You can reach out to us on LinkedIn. You can reach out to us via email. You can, like I said, you can just go to capitalvelocityinvestments.com, type a message to the chat bot, and I'll get that. All these ways and more, probably you can get in touch with us. So please let us know if there was anything that we could help you with or clarify. Other than that, we're going to go ahead and shut it down here. We really appreciate you hanging out with us whenever it is that you're hanging out with us. We hope you'll come back next week and join us for another edition of the Get Invested podcast.
See ya.